5 promises. We will halve inflation. Is to halve inflation. It's to halve inflation. The first one of my priorities is to halve inflation.
A bold pledge, a slower reality.
UK inflation drops into single digits, but the numbers still exceed all estimates.
Inflation is coming down, but not as quickly as markets expected. Fears that the Bank of England will now have to react spark turmoil on the bond markets and, in turn, the mortgage markets too. This morning, the cost of short-term government borrowing surged to more than 4.5%. That's far higher than it's been over the last 6 months. In fact, the last time it was this high...
Mr. Speaker, we're at the beginning of a new era. And as we contemplate...
A new era, it turned out, of spiralling mortgage rates as then-Chancellor Kwasi Kwarteng's not-so-mini budget panicked the markets. Activity today is less frenzied than back in September, but with core inflation still at a 31-year high, nerves remain. The fear is that to squeeze inflation even further, the Bank of England is going to have to jack up interest rates yet again from, well, they already are right now, 4.5% to possibly as high as 5.5%. That's driven some mortgage lenders to increase the cost of their products already. Nationwide, the UK's biggest building society is now charging an extra 0.45% for some of their mortgages. So if you're looking to borrow big soon, it's more than likely going to cost you more, whether or not you're buying something new or simply getting a new mortgage for the bricks and mortar you already own. That, though, is just something we all have to deal with, even if it means causing a recession, the Chancellor Jeremy Hunt told Sky News today.
Are you comfortable with that, with the Bank of England doing whatever it takes to bring down inflation, even if that potentially would precipitate that recession that you've almost just avoided?
Yes, because in the end,
even if there's a recession,
the inflation is a source of instability. And if we want to have prosperity, if we want to grow the economy, if we want to reduce the risk of recession, we have to support the Bank of England in the difficult decisions that they take.
Out on the campaign trail in South Lanarkshire, Scotland today, the Labour leader said it's decisions on Downing Street that are making all other roads more expensive to live on.
Anywhere you go across the UK, the number one issue is always the cost of living. People saying, I can't afford to pay my bills. Mortgages are a big part of that. They were high enough. They took a massive whack last autumn with Liz Truss, who put a Tory premium on our mortgages. And even now, people are paying far too much on their mortgages. And, I think there's only, one route to responsibility for this, and it's at number 10. And I think people understand that.
There are some reasons to be cheerful, though, say some economists. Yale Selfin doesn't believe a recession is likely, thinks inflation could be 3% by the end of the year, but on interest rates...
We haven't reached the peak yet, most probably, and then it may take a year or so before we start seeing interest rates going down a little bit. But in any case, we're not expecting interest rates to go back to that record low levels that we saw just before. We'll probably see interest rates staying at around the 3% level in the medium term.
Some in the city have called for calm today instead of rushing to knee-jerk reactions. But expectations over future rate rises are near universal. And costs, in the short term at least, are still only going one way.
Well, I've been speaking to Dr. Sushil Wadhwani, a former member of the Bank of England's Monetary Policy Committee, which sets rates. He now serves as one of the Chancellor's economic advisors and is Chief Investment Officer at PGIM Wadhwani. I began by asking him what the Bank of England would have to do to bring inflation under control.
I'm afraid I think that the bank has quite a lot of work to do now because inflation is coming down much more slowly than they and virtually everyone else had expected. The markets are now expecting that the bank will have to raise rates by another 100 basis points, or perhaps go up 4 more times if they raise rates by 25 beeps each time, which would put interest rates at 5.5%.
I mean, the governor was recently warning really about a wage price spiral. As people feel the pinch more and more, as high inflation has gone on, they're demanding more money in their pay packets. Are we now in that place? And if that's the case, will 5.5% be enough?
Now, whether or not 5.5% will prove to be enough is obviously necessarily uncertain. What I would point out that we haven't yet seen the full effect of the interest rate increases we've already seen. Now, as the governor pointed out after the last inflation report, several million people can expect to experience higher mortgage rates in the next 6 to 12 months. And it is only then that we will see the full impact of the interest rate increases that have been pushed through.
Well, precisely. So, I mean, might not further interest rate rises be a mistake? Because we haven't felt the impact of the existing ones yet. And if interest rates go up further, then people are going to be really clobbered.
Yes, the latter stages of an interest rate tightening cycle are always very tricky, and they involve very delicate judgments. I mean, obviously, Christian, as you pointed out, there is a risk that they do too much and induce a recession. But the competing risk they have is that if they've done too little, then inflation becomes even more embedded, and it increases the chances of the wage price spiral.
You might say that, you know, our problem has been optimism. You know, at the moment, the government still says recession will be very shallow if we hit one at all. Do we actually need to be preparing for things to be worse than we're often warned about?
Christian, very few people have accused me of being too optimistic. Now, having said that, I have to confess that even I underestimated the stickiness of inflation, and certainly now have a great sense of foreboding about what this will now mean for the UK economy over the next 12 months, because we've got this horrible combination of sticky inflation and increasing risks that not only might we have a recession, but it could be deeper than most are imagining.
How do we compare to other major economies in this respect, and how much of an agitating factor is Brexit?
So for whatever reasons, our wage growth has remained higher than in an economy like the US, and that is one reason why inflation is coming down more slowly. And I think the second factor is indeed the one you identify, Christian, which is Brexit. Brexit has made things worse for at least two reasons. One, it's exacerbated our problems in terms of labor supply, and that probably contributed to some extent to wage growth staying high. And the second is you might well have seen a recent LSE study arguing that if you look at food prices over the last 3 years, then Brexit has certainly meant that food price growth has been faster than it would have been without Brexit. And that clearly hasn't been helpful in terms of the inflationary process.
Sushil Wadhwani, thank you very much indeed.
Thank you, Christian.